In a series covering finance and investments, there seems to be a need to provide a grand summary of all the mathematics used therein. As in most fields that use numbers, we will be often starting with taking an average of something. Indeed, here you'll notice occasionally I'll show the typewriter script version for how you would approach that in Excel, the spreadsheet. We sometimes use Greek notation because in finance we have the entire population, and while not quite relevant here, it does pop up a little bit later. We will take a weighted average, which is just to apportion any portfolio, any measure, where the entire amount is 1 or 100%. We're particularly concerned with compounding, what Einstein said was probably the most powerful of equations, and certainly the future values are relevant, but we tend to concentrate on present values because those are the ones in which we find most transactions take place. That is right now in the present. While not obvious unless pointed out, the equation for the present value of an annuity is the equation of a perpetuity, the reciprocal of a given rate, minus the delayed present value of another perpetuity in the future, which is subtracted therefrom, and of course leaves the present value of an annuity from now until that discounted time. One of the basic tools is something called net present value, where you just merely take the present values of the monies coming in minus the present values of the monies going out. And the rule is you generally accept it if it's positive, and if you're constrained, much like the packing problem, you probably would prefer the one that has the highest modified internal rate of return, namely the amount of a discount rate that would set those present values in a net basis to 0. There are some tricks to the trade, such as the rule of 72, namely the rate as a percent times time will equal 72 if it doubles. 8% at 9 years or 9% at 8 years, 72. If it is continuously compounding, you can use the concept called E, which I presented here, which interestingly is not available as a shortcut in Excel, as is the number pi. And should you need to use E and don't have it handy or forget it, you can compute it easily by just taking the infinite summation, you only have to go about 20 places, of the reciprocal of your index as a factorial. While not as commonly used in finance and investments as perhaps some other fields, you may have an occasion to run across the use of integers as opposed to continuous numbers, the latter being those that can be made into fractions. Integer numbers, you can use what's called a Chisquare Test, where you take the observed actual data and subtract the expected and square it and divide it by the expected values. In fact, we'll see that as a common theme throughout statistics. And you get the expected values by taking what you observe in the rows and the columns and just proportion them. For continuous numbers, such as, say, prices or rates of return therefrom, you would compute the variance, hence the standard deviation, the square root thereof. And noting again, because we're using population statistics, written in Greek here, that we don't do that adjustment for the sample, which is you decrease the number of cases by 1. And computationally, the variance is the squaring of the actual observed cases minus the mean, the expected, and square them and add them up and divide by the appropriate number, noticing again that common theme. For the covariation between two groups, you take the differences from the actual minus the respective means and take the cross product, the multiplication each of them, and you add those up and divide them by the number of cases. I will note a mnemonic trick because often we don't have units in finance using such as rates of return that you might think of one of them as one unit, say pigs, and the other one as another unit, say dollars, and the variance is in pigs and dollars squared, hence we take the square root. But in the case of the covariance, you don't do it, you leave it in AB units, namely dollar pigs. And a guy named Pearson looked at this and said, well, I can just cancel those units out. I can take the covariance and divide by the respective standard deviations. So to push my mnemonic, you'd be dividing the dollar pigs by the dollars in the pigs. And you come out with a correlation coefficient that in of itself has no units, but does range normally between -1 and 1. It is a measure of correlation of explained variance if you square that number. It also should be noted that we again use the Greek notation in finance, and you can call it, instead of rho, Greek, R, sample, but the computation is the same. This is in contrast to the beta, the slope of the relationship between the two sets of data. And that is the covariance again, divided by one of the variances of the other piece of the population. I like to point out that the beta is where you are aiming, whereas the correlation is the accuracy of your aim. It's used in the capital asset pricing model, where the market premium, that's the return to the market minus the risk-free, is multiplied by that very self-same beta and is then added to the risk-free. A guy named Trainer thought of, well, I can borrow and lend, so maybe I can also look at that slope of that actual premium of the particular security divided by the beta compared to that of the market premium. And here's a graphic of the capital asset pricing model where the beta has ceased to become a slope in this case, but is instead used to help price the appropriate return to a particular security. Here the slope is actually that of the Trainer equation. Random number generation is particularly useful in finance and investments, and there's a uniform distribution which creates a flat distribution of numbers between 0 and 1, and I show the Excel typewriter print version thereof. The Excel normal distribution has some very problematic attributes, especially in finance, so thus I present the equation here where you plug in two different uniform distributions to create a normal distribution. And one can create, for example, price sequences where you take the previous price times the principal, that's 1, plus the normally distributed number, and you can put a mean slope in there if you like. And generally speaking, the function of time property is such that you would take the normal distribution and allocate it by its standard deviation by the square root of time. A portfolio is a bunch of different securities, whether it's a company and its product lines or a mutual fund of securities, and it adds to 100%, namely 1. And oh, by the way, some of those weights could be negative if you're borrowing them. That's okay. The variance of the portfolio is a square matrix of all the covariances, again weighted, and turns out, if you follow it through, the ones that are on the same row and column on the diagonal turn out to be the variances. And if you have what's called a naive portfolio, where you just simply put the weight equal to 1 over n for each one of the securities, that as you expand it, diversify, all the variances approach 0 as n becomes infinitely large. Thus, each and individual company becomes irrelevant to your portfolio. And in fact, that kind of means you can skip following company news. Well, with a matrix of 1,000 by 1,000, if you had that many securities, say like a good large indexed portfolio, you'd need 1 million computations, and it turns out that's really not quite necessary. Consider that any two securities can be made into a portfolio of one, namely, like, say, a mutual fund, and thus we can always look at a two-case, two securities, where one has the weighting of the remainder subtracted from one. And when one makes that kind of a substitution, one finds the math becomes quite easy and some interesting observations can be made. Thus, a two-asset portfolio has a return of just a weighted average of the returns, and for the variance, we're calling it squared inherently. In the case of a correlation being perfectly one can see the parallel of the weightings, and because it's squared, you square them. And then if one recognizes that you now put in the correlation to the last of those 6 coefficients in a row, that it is just the covariance term. And interestingly, if you take the derivative of that with regard to the weightings, you can find a minimum variance portfolio, which turns out to be the other variance minus the covariance over both of the variances minus twice the covariance. By the way, as it turns out, we don't necessarily want a minimum variance portfolio, but it serves as a benchmark to tell us where's the boundary where beyond which any weighting would be irrational. Here's a graphic of a two-asset portfolio, and it shows the various combinations of rate of return and risk in standard deviation units, and shows the minimum, which may not be preferred but does show an absolute limit for any kind of irrational portfolio choices. A bond is a debt instrument comprised of two pieces, an annuity and a single sum, the annuity being the interest payments and the single sum being a face value, which is always computed as 100 percentage points of face value. In actuality, the payments are made twice a year of half the amount and properly would be compounded twice as often at half the rate of half the amount, but computationally is not that big of a deal, at least for academics. One will note, whether it's by observation, the equations, or actual computations, that bond values move inversely in terms of direction from changes in discount rates. Could be because of the level of interest rates of society or that of the company itself. If one were to consider those changes in bond prices due to interest rates, it turns out per Macaulay it's called duration, and winds up being the maturity of any single payment bond, such as a zero coupon bond, or approaches 1 plus the reciprocal yield in the case of perpetuities. Here's a graphic. And per Macaulay, if one wanted to try and avoid interest rate risk, one could immunize the portfolio by dollar weighting the assets with the dollar weights of the liabilities. Very difficult for banks to do, and whatever solution would then avoid interest rate risk. Banks, because of the reverse nature of their business, require negative durations, and by the way, that's actually solved by what are called inverse floaters, and is even more confounded by the nature of the yield curve, which has 3 unobservable components. That is the real rate of return, that's Fisher's equation, where you add in preference for consumption to expected interest rates, which can be wrong, to forward rates, which are the expected future rates, which are the cross products, as well as the preference to have safe investments and safe borrowing, which makes the curve upward yielding if you think about it. In looking at common stocks, unlike, say, preferred stocks, which are properly viewed as perpetuities, common stocks, the dividends can grow, and per Myron Gordon can be shown to be the next period dividend divided by the discount rate, say from the capital asset pricing model, minus its growth rate. Many firms, the growth rate is the fraction of achieved earnings times the retention rate. Dividends is the payout ratio, which is 1 minus the retention rate times the earning. So that firms that have a realized return greater than its discount rate will trade above their asset values and vice versa. And moreover, if the actual return is better than its discount rate, is better served if the dividends are lower and the growth rate is higher, and vice versa. Not often noted, but very useful both computationally and in practice, is that the model has 1 plus G times the current dividend for the next dividend divided by K minus G in the denominator, which in of itself can be viewed as a growth-adjusted discount rate if viewed in the reciprocal. Meaning if the growth rate is, say, 2% and the discount rate is 7%, the difference is roughly 5%, which acts as a quick method for making computations with growth. While counterintuitive to many until demonstrated, the achieved rate of return to the investor for common stock and for non-callable bonds is the discount rate, not any other rate, such as the achieved rate of return. I do know I use non-callable bonds here because a callable bond is asymmetric on the top side, having its potential gain truncated by the call provisions if extant in the debenture. Of significance are derivative instruments, including options, which are asymmetric future contracts that are one-sided, and they allow a person to buy at their election or sell at their election an underlying security, and they're respectively called calls and puts. Here's a graph of a call. You pay premium for that. Here's a graph of a call when you sell it. You receive premium. And here's a generalized graphic including puts, which are symmetric in the other direction. The Black-Scholes options pricing model is actually only valid for call options. The put options are bounded, meaning a security cannot go below zero, but is generally in the relevant range, roughly regarded as mirror images of each other. The valuation of options is a function of time, generally the square root, the volatility, the standard deviation of the security, the nature of whether the stock price, the moneyness between the exercise, strike price, if you will, and the security is close by, expectations, including the possibility, especially for puts, for dividends, and interestingly for instantaneous compounding of interest rates, where they use that E computation we looked at earlier. Foreign exchange is a particularly relevant futures contract, and it should be viewed either from one point of view or the other country's point of view consistently, and in that case is always the reciprocal. And one way to always view it, once you've set up a perspective, is if you start at home, you go through time, thus it becomes the future forward exchange rate. If you are viewing the rate of return in the other country, then it must be made earlier. That's using the spot price. It's called the interest rate parity theorem, and it says one equals the other. While not quite as profound, there's still something of note and interest is the economic order quantity, originally called the Tobin-Baumol model. And it says that, you have more orders, well, that makes more trips. But on the other hand, if you have more inventory with less trips, but then that's more inventory. And it turns out, if you just solve for the derivative, of course set it equal to zero, the solution, as a result, finds that the ordering cost, when equal to the transactions cost, which is the solution of 2 times the usage times the transactions cost divided by the carrying cost, will provide a total minimum. Finally, and in a way maybe just as important, is a discussion on taxes. It turns out that if one looks at either a before or after tax net present value of a loan, counterintuitive to some people is that it is properly zero, meaning the discounting process captures all the interest expenses. In looking at retirement plans, the Roth IRA, as it turns out, will give you the same return as a traditional IRA if you have the same tax rates at the beginning and the end. That is to say, if you expect to retire either in a state that has lower income taxes or in a state of having lower income, you would actually be better off with a traditional IRA, contrary to some gurus. Likewise, not often noted is that a Roth IRA, because you are setting aside more without a deduction to begin with, winds up in at least high bracket states having you set aside about 50% more. This has been Dr. C Invests.